Hi, this is Zak Mir, editor of Spreadbet Magazine, with a look at some key speculative oil and gas stocks on the London market. And I'm starting off with Bowleven, where we have a potential base here in place at and just below the 30 pence level, something which is indicated by the red support line in the price window. We've also got an extended RSI uptrend line from November running through around the 32 level, and there's been a bounce off that to start this week. The only problem is that if we do break back below, say, 29, 28 pence again, we do have the risk of a final move towards the floor of the falling 2013 price channel as low as 25 pence. But there is at least the first reasonable sign of a recovery here. If you're cautious on the stock, maybe wait for the 50-day moving average at 34 pence to break. The upside, if all goes well, and we have actually bottomed out just below 30 pence, will be back towards the November gap through 50 pence over the next 1 to 2 months. So sort of light at the end of the tunnel possibly there for Bowleven. Not quite the same situation as far as Xcite Energy is concerned. A really rough breakdown here from, I suppose the trigger point was breaking the 80 pence, initial 80 pence March support. The shares tried to rally after that and failed at the 50-day moving average, and then slammed back down again below 80 pence late last week. Situation now really is that we've also broken the 2012 floor at 64 pence, and if we really close below that today, one would be looking for further losses, perhaps towards the floor of a falling 2011 price channel as low as 45 pence. The only real plus point here is that the RSI at 17 is very, very oversold. So there could be an initial reaction at maybe a bear trap rebound back towards 65, 70 pence, something like that, maybe even 75 pence. But overall, it looks as though the shares, after such an extended mid-move consolidation of the early 2011 decline, which was from £4, it does look as though we really have to explore the downside or further downside before lasting recovery can take place. Situation where there seems to be a better chance of recovery, at least in the near term, is Falkland oil and gas. Here we had the big breakdown via an unfilled gap to the downside in the autumn of 2012. The current position gives us the impression that we're in a sort of wedge recovery situation, a wedge, a sort of triangle set up here. The big plus point in the near term, or the big plus points actually, are a combination of a rising December RSI support line running through around 35, and the way that for late March we've got a new higher low above 25 pence, which could actually lead the stock higher. At this stage, probably you wouldn't really be looking for much more than August resistance at 32 pence, but it's a decent trade to say that while above 25 pence or even 24 pence is a sort of a maximum stop loss, we could head back into the low 30s again. If you want to see some more evidence of a break to the upside, maybe you'd wait for the 200-day moving average at 27 to break, or further consolidation for the RSI above neutral 50. It's just below that level at the moment. Difficult to finish off without looking at Gulf Keystone, where there's been a fresh leg to the downside to start this week, 7% or 7 pence decline here. The big sell signal, big sell signals are all over the place. In fact, going into from February to March, we had the head and shoulders breakdown, loss of the 200-day moving average, £1.66, and then the unfilled gap to the downside a couple of weeks back, which has really sort of accelerated the things in favor of the bears. The floor of a falling trend channel from 2012 currently runs towards 60 pence. And I think it would be difficult for the stock to avoid hitting that line, 2-year support line, given how bearish we've had the setup here. We couldn't even break back above the 10-day moving average of 103 pence on the latest consolidation. So below, say, the 10-day line, 103, as low as 60 pence over the near term. RSI configuration also looks rather weak, but not too weak in terms of being 22. It's not a sort of sub 20 RSI level yet. So there is room for a fresh downside at Gulf Keystone. and really we need to get back above £1 very, very quickly to avoid the worst case scenarios here. That's it from me. See you again next time.